Here's a list of the transactions that we're going to run in our small business simulation for our services business like you've got. So we're going to start off with, first thing we're going to do is start the business with $1,000 from your account. So this is your outside account, this is your private account. You go, great, let's start the business with our $1,000. Our second transaction is we're going to sell 5 hours at $100 an hour and get paid cash for the work. Our third transaction, sell 5 hours at $100 on account. So we'll see the difference between cash and accrual accounting. Transaction 4, have a subcontractor deliver the work. Transaction 5, get a loan for $10,000 and get a vehicle. Transaction 6, we're going to sell another 5 hours at $100 an hour on account, register the car for $300, insure it for $100 and put $50 worth of petrol in it. Then we're going to, unfortunately, is what happens in business, we get a bad debt. Transaction 8, we're going to pay our employees. Transaction 9, we're going to sell another 5 hours at $100 on account. Transaction 10, we're going to get paid. Woohoo! $1,500 worth of money comes to us. Transaction 11, we're going to pay our supplier or our subbies. In this instance, we're going to make a car repayment, of which is going to be $100 interest. And at the end, our last transaction is related to tax. We're going to depreciate our vehicle by $200 and how the tax implications play out from that and see what EBIT and Ebitda means to help you get your head around that. So let's rip in. G'day everyone. So now we're going to hook it all together. Let's see how all these financial statements hang together with a test business. Our balance sheet is like a snapshot in time. It shows us at any one instant what our business owns, the things and stuff that it owns. It shows what we owe to other people, the money we owe. You can't owe things and stuff to other people, but it talks about the money we owe. And then the difference between those is the equity, or what the business owes us. So this is a snapshot. The balance sheet is the most important part of the financial statements, and it's the thing that holds everything together, as you're going to see as we go through this. So let's imagine we're going to start a business, and we're going to start with $1,000 from our own bank account. And we're going to set up our financials, whether we've got Xero or QuickBooks organized. This is how it all starts to happen. Okay, so we're going to take $1,000 cash and we're going to add it into the cash section of our balance sheet. Now, I want you to really understand something about the balance sheet, and that is to do with this equation here that you've seen in the other videos. Total assets equals total liabilities plus equity. Or if you rearrange the equation, if you've seen in some of the other videos, it's equity equals total assets minus total liabilities. And that is key in business and the accounting system. That's why we have double entry accounting, and the balance sheet is the most important of all your financial statements. It must balance. This is the rule of accounting. It's like a gravity rule. If you mess with this, your numbers don't make any sense. And you're going to see as we go through this why the balance sheet is so important in that way, why it's set up this way for a series of balance and checks as we go along. It's to make sure we don't mess our numbers up. It's actually very clever. If you get it right, it will balance. Now you can see over here, I've got a big cross and a sad face because at the moment, it doesn't balance. The total assets don't equal total liabilities plus total equity. And your accounting system will flag errors like this when you do it. So we've taken our $1,000 cash from our bank account and we set it up into our balance sheet. But at the moment, it's out of balance. So we need to add this particular entry of $1,000 to starting capital. And you'll see we're all happy now. So let's just break it down what these means. Assets in your business is things that is owned by the business. And I want you to make this really important distinction. You are not your business. The whole point of the accounting statements and setting up structures and that is that you are not your business. As your business grows, you're going to start to realize this. Assets we have at the moment, our things is cash. And as we go through this example, you're going to see other bits and pieces of how this works. So you can see we have total assets here of 1,000 and we have a starting capital of 1,000 and total liabilities plus total equity of 1,000. So we don't have any liabilities at the moment. You'll see that as we go through. Now, you'll notice that your profit and loss has nothing on it. Your profit and loss is like your report card for how you play the game of business. Now, at this point, We've just kind of entered into the competition. We've paid our entry fee with some money to start our business with, but we haven't actually ran onto the field. We haven't generated any income or got any sales or paid any bills or anything like that. That will come when we get through the rest of this, as you'll see. Hopefully, if you've watched all the other videos, you'll see what I'm talking about in that context. And I've hidden it to start with over to the side here, is the cash statement, which is the one that most people are completely unaware of, yet it's the one thing they're probably most interested in because it tells you where your cash is. So what we need to do with this statement now, and what would have happened, is that everything goes through the balance sheet and it gets automatically connected to these other points. And this is where double entry accounting comes from, okay? It has to go in two places. It always goes on the assets or on this side over here, the liabilities or the owner's equity, to check, to make sure it's always balanced so that we don't get any mismatches. Now, how that would play out on your cash statement, and if you've watched the videos, it's basically what actual cash comes into the business, what cash goes out of the business. So in this instance, and what your starting balance was. So we didn't have a starting balance to begin with. So let's say in this instance, we've had $1,000 come into the business. So that is all our cash statement will look like. Now, the interesting part here is the connection here between your cash statement and this part of the balance sheet is that's where this number reflects. Your ending cash is what's in your cash box. So picture you've got a cash box, like a piggy bank or a money box. It's a thing. It's owned by the business, not you. You as an owner have equity in the business, which is what the business owes the owners. And then we need to take away from the assets what the money is owed by the business to other businesses. As we go through, this is going to become clearer and clearer. So let's move on to our second transaction. Okay, so transaction 2, we've got out and done some hustling, and we've been managed to sell 10 hours of our service at $100 an hour. So, and we get paid cash. So how does that flow through our financial statements? First of all, we're going to go to the P&L. So we've written an invoice for this person. Every time you write an invoice on a P&L, it turns up every time you generate an invoice, it turns up straight away on your P&L. And every time you receive an invoice and enter it to your accounting system, it turns up here as well. So what we're going to do is put in $1,000 for our sale. Now, in this instance, we've decided to pay ourselves $500. You know, it's our business and so forth. So we're going to put in a wage of $500. Now, if you look at this, we've got no cost of sales because we're selling time. And I'm going to talk about what happens when we use subcontractors in one of the videos a bit later on. Or if you've got team, you can sometimes put them into cost of sales, but I'm not going to go too deep into that. So our gross profit is our income minus our cost of sales, so $1,000. Now our net profit is then calculated by our gross profit minus our operating expenses. So we put in $500 worth of wages. So our total OPEX, and you will hear it called OPEX sometimes, operating expense, is 500. So 1,000 minus 500 gives us 500. Now, you'll notice that we've gone out of balance here with our balance sheet. And here's one of the places that we get connected between our profit and loss and our balance sheet. So I'm just going to copy this arrow here and pop it over here so you can see what happens and see this connection. So our net profit is shown on our balance sheet at a place called earnings to date. So it's part of the equity section. So this is how your P&L connects to your your balance sheet. Now, because of that, it's out of whack. Now we know we had $1,000 coming in cash, so we need to go over to our cash box and put it in here. But we also had $500 go back out. So the net change here is we now have $1,500 in cash. So happy smiley faces again. However, we do need to fix up our cash statement because you can see that this is no longer connected to this. They're not equal. So what we need to do here is we had $1,000 come in, but we had 500 go out. So we would write in here, now $2,000 has come into our business, but 500 went out. And remember, your accounting system does this all automatic for you. So now you can see we're back to these figures being equal. Everything is balanced and we've got some motion happening with our business. Let's move on to our next part, transaction number 3. All right, so it's time to do transaction 3. Business is going good. We've been able to sell another 10 hours at $100, but this time it's on account. So the person's going to pay after the work's been delivered, or there will be some time delay. So we're going to have to set up an accounts receivable. So let's see how this plays out. So we've got another income or more sales of another $1,000. So we're going to increase our sales over here. Remember, your system Zero, MyOb's doing this automatically for you. And see, straight away, we've got our unhappy person here because we're not balanced anymore. Our earnings to date are out of whack. We're not also going to pay ourselves this time. So how do we get this to start to balance up? This is where the accounts receivable comes in. So back over to our balance sheet, we now have got accounts receivable. So these people owe us money. So we're going to put in our $1,000 in here. And there you see, we're back to balanced again. Now, no cash has moved, so this doesn't need to change. On the surface, our business is looking pretty good so far. You know, we've got a fairly high profit. But let's wait to see how it all starts to unfold with our next transaction. Okay, so business is going well. Transaction 4, we're busy. And we've got some work to deliver now, and we've decided to get a subcontractor to help us deliver it. So how does that play out? This subcontractor, we know this person, they're trustworthy, reliable, and they've decided to do the job for us to help us out, and they're going to do it for $50 an hour. So that means 10 hours at $50 an hour is $500. So we're going to pay them $500. Now, how does that play out in our financial? So let's go to our profit and loss, and we're going to add in here cost of sale, $500. Now, this is not an employee, this person. You'll see how this plays out differently as we start to go along as the noisy motorbike goes past. So $500 to our cost of sales, and you see straight away we're out of balance. How do we balance this? Now we have a liability. This person, we owe them money. This is just a paper trail. Your profit and loss is just theory until the cash moves, right? The cash is what really counts at the end of the day. So we're going to add in $500 here. We owe our friend, this person, $500. And boom, we're back to balance. And you can see this has had a slight effect on our P&L, that our net profit has gone down as well. So that's how we deal with our subcontractor work. Now, some businesses will use their employees they will put up in cost of sales. It depends on what sort of business is and how your accountant likes to do it. Either way, you need to decide this with your accountant and work out what's best for you and your business. Okay, let's move on. Okay, so transaction 5, business is going really, really well. We've decided that we need to get a vehicle to start to get around a bit more effectively rather than using our own car, and the business is going to pay for it. So we've only got $1,500 in our cash box or in our bank accounts. That's not going to go very far in terms of getting a decent car. So we've decided to get a loan. So we've been to the bank and got everything approved. And let's see how this all plays out through our financial statements. Now, fundamentally, you're not going to see anything happen on your profit and loss or your income statement here with this transaction. Now, our profit and loss or income statement is a little bit like a report card. So at the end of the school term, when all of our marks have been added and tallied and so forth, it's the end result that we get. It's a bit like a score sheet in a sport. It records it at the end of the game. There's not much you can do with it other than learn from it. It tells you whether you had a good game or a bad game. It's basically a representation of how well you've run your business. So if you've been able to take the revenue you've generated, minimize your expenses and create a good profit, then that's a pretty good sign. If you've made a loss, then you haven't done a real good job running your business. But just remember, as you've probably seen in some of the other videos, profit isn't cash. Your profit statement, your profit and loss income statement is just theory because it's generated on invoices. It has nothing to do with the flow of cash. But it is a representation, if everybody pays their bills and you pay your bills, of how well do you manage your resources for your business to turn it into profit that we can then turn into cash. Where you will see it move around is on the balance sheet. We'll talk about the depreciation of the vehicle and so forth later on. So fundamentally, the bank says, great, you can have a $10,000 loan. So into our cash box, we'll go $10,000. So we've now got 10,000 plus 1,500, $11,500. Now, immediately, you're going to see we've got a bit of a problem here because we're out of balance. But now we have a loan on this side of $10,000 to balance out, and happy smiley faces, we're back in the balance. Money's in the bank account, we go out to the dealer and we buy our car for $10,000, and now we have an asset. So you're going to see there's current assets here. So current assets are things that can be turned into cash within the next 12 months. So as we go down the list, it increases as you go up for liquidity. So stuff at the top of these lists is generally easy to turn into cash quickly. Liquidity, like a liquid, it flows quicker. Down the bottom, it takes a little bit more time. So current assets. Now we're going to take that cash out of our cash box and give the dealer the $10,000. Oops, sorry, the vehicle, the $10,000 over here. And now our cash has gone back to, so we've turned that cash into an asset. All right, we're back to happy faces. So we're back to our 1,500, which is what we started with. How does that play in for our cash statement? Again, we haven't touched the P&L. We added 10,000 into our cash. So $10,000 went in. So 2 plus 10 equals this amount here. And what went out? 10,000 went straight back out again. So now we put in our 10,000 and we take off that 500 as well. So 9,500, sorry, 10,500, my bad, 500. And you can see we're now back to a balanced state where this lines up. We've got our accounting equation squared away. So we're good here and everything's balanced up. So that's how we do our vehicles. Okay, so transaction 6, we've been out knocking on doors and we've been able to sell another 10 hours of our services for $100 an hour on account again. So we've got our person lined up ready to do that and they're straight away. So we've given our client the invoice and our person's doing the work. And by the time this video is finished, they'll have done the work and they'll have given us an invoice. Now, our new car, we've got to register it for $300. We're going to insure it for $100 and we're going to put $50 in the tank. So first of all, how does this all start to flow? Well, we've got $1,000 worth of extra sales or income. That's added in here. 2,000 goes to 3,000. And that person's just given us their invoice for the work. So there's another $500 that needs to go into here. So this now becomes 1,000. This is a cumulative total, remember? Now, that takes care of that part. So we've now got another $1,000 we need to add in over here for receivables. So we're going to add 1,000 dollars to this, and you'll see we're out of balance. And then over here, we've got the $500 for the person we need to pay. So that goes up to $1,000 and yippee, we're back in balance again. Okay, now you notice we haven't paid that person yet. All it has been is paper shuffling, which is what happens with your P&L primarily. It doesn't tell you your cash position. Keep drumming that in. Now we've got rego, insurance, fuel as well that we're going to have to put into here. We're going to get to bad debt in a while. That's in one of the other videos coming up. So it's a cost of doing business. So it goes into your operating expenses, as you'll know if you've watched the other videos. So our rego is $300. Our insurance is $100. And we're going to put $50 worth of petrol in the tank. Now you notice we've gone back out of balance. Okay, so we need to bring it back into balance. All right. Now, so how do we do that? And I just had to adjust the total operating expenses. It wasn't adding them all up. Now you can see we're out by $450. Now with what we've done is we're going to put the fuel, the rego and the insurance on account. Okay, we're not going to pay for them today. So we put in $450 into here and bingo, guess what? We're back in balance again. Again, no cash has moved in this one. Let's move on to our next transaction and see what unfolds next. Our next transaction is an inevitable part of business. We get a bad debt. Someone had agreed to pay us and we've given them an invoice and they've given us the purchase order, so we're all okay. However, they still went out of business, so we're down $200. So how do we do bad debts? Bad debts are considered a cost of doing business. So from our P&L perspective, we're going to put it in under expenses. Bad debt. It's only $200 and you'll see immediately it has an effect on our profit. Yep. So we're out of balance. Where we balance it here is in our accounts receivable. That person who we were hoping to receive money from for the services we delivered is no longer around. So we take a hit. So our accounts receivable needs to go back to $1,800 and we're back in balance. Again, No cash has moved. So we're back to balance, learned our lesson, and we move on. All right, we're up to transaction 8 of 12. So I've got this and 4 others to go. It's time to pay the employee we brought on a couple of weeks ago. And we said we paid them $500. So it's payday, time to pay them. So we're going to go over to our wages, P&L to start with first. And we're going to put in, add 500 to the 500 we've already done for this P&L. So this number becomes 1,000. And immediately you see we go out of balance, our profits dropped. We're going to take 500 off our cash balance here, our cash box. So we're back into balance. Now, what about our cash statement? So there's no cash has come in, but there's more cash that has gone out. You can see we're different here by that $500. So we're now going to take cash out. We're going to add 500 to this. So we're down to 11,000. The cash line's up again. So that's what happens when we pay our team members. I'm leaving tax out. If you want to find out about tax, you need to talk to your accountant. Okay, let's move on. Transaction 9. Business is going good. Our profit's a little bit low. We're getting a little bit scared. Our cash is low. We're going to need to get some money in, but we still sold another 10 hours at $100 an hour on account again. So you can pause the video here and have a go at what you think is going to happen. Or I'm going to show you, take you through it now. So our sales or income for the business went up by $1,000. So we now have $4,000 in our P&L for this particular month. Straight away, we go out of balance. Can you tell on our balance sheet where we need to add it? We did 100 hours on account, so we're going to add another $1,000 to our accounts receivable to bring it back into balance. So this now becomes 2,800, and we're back into balance. Now again, hasn't been any cash movement. We're getting a little bit nervous in what's happening with our cash and so forth. Now you notice we didn't get an invoice from our subcontractor this time. Maybe that'll happen in transaction 10. Let's have a look. Ooh, payday, transaction 10. We've been paid by some of our clients. We've had $2,000 come in from a variety of places. So how does that affect our financial statements? Now, cash coming in doesn't do anything to your profit and loss. Remember, it's got nothing to do with it, but it does have to do with balance sheet and cash statement. So we've had 2,000 come into our cash box. So we go from 1,000 plus 2,000 gives us 3,000. Oops, 3, 1, 2, 3. And you'll see we're out of balance. However, our accounts receivable now gets reduced. So we take 2,000 off this, it goes down to $800. And boom, we're back in balance. We've had 2,000 come in because you can see our ending cash here and our cash box are out of balance. So we're going to add 2,000 to our cash in because we had an additional 2,000 come in. That takes us to 14,000 and we're back in balance. So our balance and financials are all in alignment. Now, last transaction, our subby forgot to send us the invoice for the work that they did. So they've sent us their invoice for their 10 hours at $50. A cost of sales, that invoice coming in means that the cost of sales goes, add 500 to it, $1,500. We're out of balance. We need to pay them. So this is where we log it here. We add $500 here. And across the board, we're back in balance again. Cool, we've got some money in the bank. Let's see what happens on our next transaction. Transaction 11, 2 to go. How are you going with this? You're keeping up. All right, so transaction 11, our supplier, our subcontractor guy who's been helping us out, he's asked us a few times, when am I going to get paid? When am I going to get paid? Well, we're ready to pay him now. We feel like we're comfortable enough and just had to be sure we're ready to go. So how does this play out paying the cash? Now, remember I said it's got nothing to do with P&L. It's only going to be balance sheet and also cash summary. So we're going to take $1,500 out of our cash box to pay him. So this goes back to $1,500 and we're out of balance, but now we don't have any accounts payable either. 0, boom, we're back in balance again. From our cash summary, cash statement, so our cash out is going to increase by $1,500. So that's going to go to 12,500. And our cash box is all back in balance again. Now, we've also got to make a car repayment, a total of $600. That was what we agreed when we took the loan out. It's that time of the month when we've got to pay the loan. Now, $100 of that is going to be interest. Okay, so we're going to take $600 out of our cash. This goes back to $900. We're out of whack, as you can see. Our vehicle loan gets decreased by the $500. Now, the $100 of interest, you watch where this is going to go. So now our vehicle loan is $9,500, but we're still not in balance. interest is considered an operating expense. It's like renting money. It's like you've got a building. If you had rent, it would turn up in here. So our interest is $100, and you'll see kaboom, we're back into balance again. Just remember that was a cash flow that mainly happened over here. The interest was logged onto our profit and loss as a running expense of the business, but it didn't have anything to do with the actual cash figure for the business. All right, last transaction. We're going to talk about depreciation and tax. Stand by. Okay, our final transaction. It's the end of the financial year. It's time to get ready to do our taxes, and we get the opportunity to depreciate our vehicle. Now, here's the thing we've been doing so far. Our profit and loss, and my job as a business mentor, is to make the accountant's job as hard as possible. Their job is to minimize the amount of tax you pay. We all have to pay tax, but you just don't want to pay too much tax. So Ebitda, earnings before interest, taxes, depreciation, amortization. We're now going to take out the depreciation and amortization part with the depreciation. Now, what happens with a vehicle or any major asset like that? We get two options when we buy it, and it depends on the laws in your country as to what you can do. In our instance, we capitalize the debt, which means we put it on the balance sheet and we choose to disperse the value of that asset little by little over each year. Now, if we had a whacked $10,000 on here, let's say this was when we first bought it, instead of this saying depreciation, it said vehicle, and we expense, that's the other way you either capitalize it or expense it, $10,000, then the performance of our business looks horrible. Yeah, we don't get to pay any tax, so you don't pay tax on negative numbers, but it would be very unhelpful in terms of the information it provided. So that's why we write it off a little bit at a time, and the government decides how much we can write off. In this instance here, we're going to depreciate the vehicle by $500. So how does that work? Our asset here, its value as the asset on the balance sheet, that doesn't mean the market value. They're two very different things. The market determines what they're going to pay for it. This is from a strictly accounting perspective. So this goes from 9 to 9,500. We take our $500 depreciation off. We're back out of balance, and we're going to add the depreciation expense over here of $500, and you'll see, boom, we're back in balance. But now we can take the depreciation and amortization parts out of here. So it's now earnings before interest and tax. Now, this is not interest that we had up here. This is interest if we had other assets that provided income via interest into the business. Whoops, we can zoom back out on that one again. So, whoop, way too far. So there you have it. Let's bring it all back into perspective here. Zoom it in a little bit closer. An overview of 12 transactions and how it affects your business. Now, at the end of the financial year, you're sitting back and what do? You know, you started with your $1,000. You got $900 still in your cash account, which you can do something with. Still got some debts. You could probably sell the vehicle and clear that out. You know, you've made a 6% profit, which depends on your industry, could be good or bad. You'd have to look that up. The equity, which is what the business owes you. Remember, the business liabilities is what the business owes to other people. The assets is what the business owns, the things or stuff that it's got. So the business has got total equity of $1,250. So that's what it owes you. Now, you took $500 out previously, but there's still probably some other money that you could take out there as well. So hope you've enjoyed that, and feel free to reach out if you want to talk to me about getting mentoring. This is helping with the basic numbers. We've got to get this sorted. You've got to know the numbers before you can really seriously grow your business. Reach out. There's ways to contact me through this site here, and look forward to hearing from you soon. Bye for now.